welcome to ICICIdirect. Joining us today is Mr. Chintan Haria to talk to us about the outlook on the banking sector. Chintan, it's always a pleasure to talk to you. Given the current context and the big talking point is financial institutions in India, why do you think, in your opinion, are banks such an integral part of the growth story of any economy, specifically the Indian economy in our case?
Thanks, Amina, and it's always good to be back on this platform. Let's think of the importance of banks and let's take our mind back to March 2020. We were in the lockdown and only two things were working, right? One was the hospitals for obvious reasons, the other was banks. I don't think I need to elaborate further why banks are important, because without banking system, the economy itself cannot function, and it acts as a lifeline. So from an importance perspective, what do banks do? Essentially, they take the money from individuals or the savings from the individuals and then channelize it into the right areas for growth. Think of your home loans, for example. You want to buy a home, home loans are provided by banks. That acts as a catalyst. Think of your personal loans, think of your credit cards, think of your car loans, etc. Right? Beyond that, of course, while this is more consumer-oriented, you have these large steel plants, you have these large chemical plants, you have these large refineries, you have big projects, manufacturing hubs, right? We are trying to make India a manufacturing hub, for which you will need to put up factories, which will employ people. To put up factories, you need debt. Who are going to be providing that debt? It's essentially banks. So banks act as this beautiful intermediary, which works to funnel capital in the right area, take the money from people and invest it in the right area, and make the money for themselves. And hence, as the economy grows, banking system also grows. So if you go back 10 years, Indian economy was about $1 trillion, banking system was much smaller. Indian economy is $3 trillion today. Banking system is about 100 lakh crores or $1.5 trillion odd. So as we expecting ourselves to go to $5 trillion, banking will grow. And most important today, after 7 years of consolidation and write-offs, banking as a sector, the incumbent large banks, both in private sector and the public sector, have become bigger, and that makes them very interesting investment choice.
Indeed, Chintan, and I think we've seen that in the last few quarters, at least earnings-wise, NPAs have taken a breather for most banks. Do you think the NPA issues are behind us with the Indian banking sector?
Yeah, so let's look at the genesis of how the cycle works. 2003 to 2008, we had this beautiful bull market in the world and in commodity markets. Everything was looking good, and so corporates went and did capex. That capex boom obviously lasted till 2012, wherein the new capacities came up for which the banks had lent. Then we had this down cycle which happened in 2012-13. Many of the projects are not viable. And from 2013 till 2020, we saw the 7-year down cycle in terms of write-offs, credit costs, and NPAs on non-performing loans. The loans which were given in 2008, 9, 10, 11, because the factories which came up did not have demand on the other side, or there was obviously loss on account of commodity prices coming down, etc. That led to banks having to see write-offs, right, from institutions or corporates. Now in 2020-21, if you see, the NPA cycle is behind us. It's more about growth. It's more about the capex cycle on the positive side. So we are in the virtually opposite direction when it comes to banking sector, where they were plagued with all these write-offs and big write-offs leading to big losses. We are seeing the positive side of the banking system earnings, and the market is still about factoring in that. And after 2 years of underperformance, we expect next 2 to 3 years banking system to do much better and banking stocks to do much better.
And I'm going to take a cue from that, Chintan. You indicated that banks have been underperforming and have not really participated in the rally that we saw over the last year and a half. Have things changed? Do you now think investing into the financial sector through banking stocks is a good investment opportunity?
Yes. So if you see in terms of investment behavior, generally investors like to be, let's say, investing in sectors which do well. So which was the sector or segment which received the highest money in 2019, 2020? It was Brazil, because Brazil did well among investors who are investing. Then China obviously did well in 2020. 2021, it was essentially US technology. We all know that a large amount of Indian money is invested in US technology or growth-oriented sectors in US. Banking sector for the last 2 years has underperformed for obvious reasons that people were looking more towards the growth-oriented technology sector. And that gives us an opportunity right now for investing in the banking sector, which after the consolidation phase, after the write-off phase, is coming out probably as a winner over the next 2-3 years in terms of expected earnings growth and also in terms of positioning, if I look at it, because foreign institutional investors were the largest investors in banks and they've been selling for the last 4 months. From a timing perspective, also, it's a good timing because foreigners having sold 1.5 lakh crores of equity roughly in the last 4-5 months. That's a huge amount of selling that would have happened in banking also, and hence the banking sector is available at relatively reasonable valuations compared to the market.
Chintan, with the recent rise in new age fintech, the financial sector has gone beyond just, your traditional banks or traditional lenders. Now, how does a client or how do different, sets of clients take exposure to the banking sector appropriately? Because on one hand, the sector has got such a wide landscape. So the understanding also might be limited for some clients. In your opinion, what is the best way for an investor to take exposure to the banking sector?
Sure. So in terms of investing in banks, of course, you need to diversify. And we know mutual funds are a good way to diversify. Within mutual funds, you do have an option of investing in the active side of the banking and financial services fund. And the other investments are bank ETFs or a private bank ETF, or of course, the index fund route. And that's where if you want to invest in pure banks, the bank index fund is a good option for investors to invest. It comprises of 12 of the largest banks in India. And if you look at it, the core portfolio there will be the household names of banks, which all of us can see. And, they are the maybe 80%, 90% of India's banking system as well. So we are bullish on the banking system. We know that the corporate credit cycle is good. Also, the retail growth in India is also going to be strong. So at least for the next 3-4 years, the larger banks who have access to capital. To grow a bank, you need equity capital, and equity capital is easily available for the larger banks. So investing in that space through the bank index fund is a logical extension for all investors, is what we feel.
Chintan, for most investors, the ideal portfolio stance is maybe have a core portfolio which is made up of a diversified set of mutual funds, passive, active, but more diversified in nature. Satellite, of course, investments can be sector-specific funds. And that brings me to the next question. Talk to us a little bit more about the bank index fund. How is this different? What is its offerings, its unique proposition?
Yes, so we keep it very simple in terms of how we look at people should allocate the money. The core part of 50-60% of the allocation should be in asset allocation funds, which is the balance advantage fund category. If you look at beyond that, 20 to 30% fund can be depending on the investor's risk appetite into either the small cap, mid cap, large cap, flexi cap. That totally depends on the investor's risk profile. And the balance 20-30%, like you said, the satellite portion or the residual portion, I could say, most people are looking at passive investing. They're also looking at gold. So I do believe 5 to 10% of the allocation of an investor should be in gold as well, and via the gold ETFs. And 5 to 10% or 15%, which you're looking at thematic investing or a sectoral investing. Today, the sector which is looking interesting for the next 3-4 years is the bank index or the banking fund. And the banking index fund, like I said, is comprised of 12 stocks. It is an index fund. It is a passive fund. It basically mimics or replicates the index, where if you look at the largest banks of India are represented, because it is a market capitalization free float based index, you'll find the larger banks represented in that. And investors can get the benefit of having 12 banks, 12 of the largest banks in India in one go in the proportion that they are in the index. So for an investor to pick up, if you want to invest in the banking sector in India, this becomes a very good addition to the portfolio of every investor. It is in the index form, so you do not need a demat account. You do not need a trading account. You can simply invest in it, much like any other mutual fund that you do. And you will be able to do SIPs as well in it. And we believe that even for a lump sum investment, currently is a good time if you're booking profit from other equity funds. Thank you.
Right. It's also very convenient for the sake of our investors. So when the Indian economy is showing signs of recovery, Bank Nifty up until now has been an underperformer, but Chintan believes it's up to see outperformance in the next couple of years. So would be a good sector to get your hands on. Great talking to you as always, Chintan. Thanks for joining in.
Thank you so much. Always a pleasure.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.